Hello, everyone. I am Liz Dysart with the Crawford Team of VIP Mortgage, and I am here with Stuart Crawford, who is one of the VPs of VIP Mortgage, and he is the founder of the Crawford Team. He has been in the loan business for about 18 years and is an expert on loans in the financial markets. So we are here today to help our agent partners understand what new changes are going on in the market and really how we can help you educate your clients, and how ultimately we can help you get more deals done. So without further ado, I'm going to introduce Stuart, and he is going to present some great information for us today.
Hey, everybody. Good to see you. Liz, thank you as always for the awesome introduction. I don't know if I'm an expert, but I guess if you do anything this long, you should be some version of an expert if you were paying attention, right? So I appreciate it. You're amazing. And if any of you guys don't know Liz, you should get to know her because Liz is an absolute professional and top notch. And we're extremely lucky to partner together. And we just love you, Liz. And thank you for everything you do for us. And you're one of my favorite people. So
you too.
So yeah, let's get to it. Let's roll into it. And I'll give you guys, hopefully some good information.
Absolutely. So today, the topics that we're going to discuss briefly, and then we will open it up for all of your questions. We're going to talk about the COVID recovery and what that's looking like as we are a year plus out after this pandemic, the current situation with financial markets and rates, current availability of products and programs, a lending forecast. Although we don't have a crystal ball, there is some great data that can help us predict what could happen with mortgage rates. And then we're going to close with a little discussion on how some of our best agent partners are winning their offers and how we are helping save deals, because there is a lot of craziness going on in the market right now. So we will get started with a little discussion on mortgage news, what we're seeing now, and the COVID recovery.
Sounds good. Well, I think as you guys might know, interest rates move with news, right? So I've always said that the markets are emotional. So what's happening in the stock market is usually an emotional thing. It's a reaction or a trigger to some headline, to something occurring in the world, something occurring domestically, and then as those things occur, people trade money in a certain way, and that affects the way that bonds move, and bonds have a direct correlation with how interest rates will move. And I promise I won't bore you guys with all the technical details of how all that works. But if you're ever interested in that, Liz knows I can talk your ear off on that stuff. So you can always reach out to me separately. But all that being said, what's happened is, with interest rates, we know that interest rates hit a historic low during COVID, and the general rule of thumb with rate movement is bad news is good for rates and good news is bad for rates, right? So when the economy's surging and everything's going great and everybody's high-fiving and people are spending money, typically speaking, that means interest rates should be going up because they're trying to battle inflation. The reverse of that is when people are not high-fiving and they're not spending money and they're sitting at home not knowing what's going to happen next, and they're worried about the roof over their head and everything else. So all of these things what happened during COVID, interest rates tend to go lower to drive economic activity and to get people out spending money and borrowing money. Because remember, the Federal Reserve, who controls our monetary policy, they want people out there borrowing money, spending money, and spurring economic activity because it's good for everybody, which is kind of common sense if you think about it. 70% of all economic activity is retail sales. Okay, so that means you and I going to Amazon, going to the grocery store. I don't know if anybody actually goes anywhere anymore. Everybody orders everything online, but you get the point. It's consumer spending is what drives almost everything. So when rates plummet like they did during COVID, which is fantastic for the housing market, right? We had the biggest refinance boom in the history of me doing this, and I know it was in the history of them tracking rates since the early 70s. It's been really good for us, and from that standpoint, and obviously as real estate agents, it's been great for you because it's just another sort of feather in your cap, so to speak, for buyers who are wanting to buy new homes and leverage it with a mortgage, and it allows them to have higher purchasing power because they can borrow more money with a lower interest rate. So it's been great for us, but COVID also had some nastiness around it as far as we got very conservative, the lending industry. And I don't mean to just switch gears here, Liz, but it's to come off rates for a second. But a lot of our loan servicers started to clamp down on their programs, and they put guidelines in place that made things more restrictive. And we'll get a little bit more into that later in the discussion. But some bad things happen, even though we had a great thing with interest rates. So now let's fast forward. It's we'll call it post-COVID. People are getting vaccinated. The world's getting confidence again. The Federal Reserve is doing what they can to spur us going out and spending money, and it is happening. Consumer spending is way up. Travel is all of a sudden shooting through the roof. So all these things are good, but they should drive interest rates to go higher. And we did see that rates popped after the first month of this year. So as we got through January, rates shot up a quarter percent, excuse me. And the forecast going into this year from the big aggregators like Fannie Mae and Freddie Mac were that rates would go up by about 3/8 by the end of the year. 3/8 is 0.375. Okay, so real life terms, if rates were 3 on January 1st, they're predicting they'd go to 3.375. Well, they went to 3.25 like that, literally overnight. And then we came into the late February, March timeframe. We saw the 10-year Treasury come down again a little bit, which means that rates should come lower. And we started to see a little bit of reprieve, and rates dip just a little bit. But that party is also over, is what I've been telling people. The 10-year Treasury, I get asked all the time by clients, by realtors. I think I honestly got 2 emails this morning from clients in process saying, how do you track mortgage rates? How do I know if they're going up or down? There's all these headlines. And the reason they're asking is not only for the obvious reason, but also because when we lock a client's interest rate, we explain that we have a float down option, which means, hey, Liz, just because we locked your rate doesn't mean you're stuck. If the market moves favorably, if it comes down by a certain amount, we'll go back and get you a better interest rate. So it's a great feature that we have. But when clients know that, they kind of want to know, has that happened? How do I know if it might happen? How do I track it? And my answer to that is the 10-year Treasury index. So if you were to just jot that down, you can Google 10-year Treasury and you can track it very easily. And you don't have to do anything more than just, if the number's going up, interest rates should go up. If it's going down, interest rates should be going down. But it has to move by a significant amount for investors, which are lenders, to change their rate sheets. So if the 10-year Treasury is at 1.6 and it moves to 1.58, the interest rates aren't going to change for the most part. Most banks aren't going to change their rates. But what happens is the headlines that you start seeing online, and when you go to CNN.com or Fox News or wherever you're going to get your information for the day, you'll see the headlines that say rates dropped. And so then we get the phone calls, and then we have to dispel the rumor, which is rates didn't drop. The 10-year dropped, but mortgage rates did not drop. So I bring that up because there's a lot of confusion with that, with real-time rate movement and how headlines work and how the news kind of, disseminates that information. So
thanks, Stuart. Yeah, that's super helpful. I think there is so much misinformation in the media about that. So giving a little bit of clarity on how the 10-year Treasury affects rates, but doesn't always 100% predict rates is very important. So yeah, these were 3. One thing our team does, I think, exceptionally is we follow the financial markets very closely. Stuart was a business and finance major, and so we look at all of the weekly headlines, what's going on with the financial markets and how that could affect all of our borrowers in process. And so we're able to answer all of those questions. But when you look at, these are 3 current headlines from this week that can be a little confusing, right? So the first one, mortgage rates drop below 3%. That is very speculative and dependent on the client's situation. So national headlines like this are sometimes confusing to buyers. And the one below it, mortgage requirements are loosening for home buyers, obviously a very positive thing after all of the tightening that happened during COVID, but that can also be misleading to people. The third one was one that just came out today, actually, about Bank of America and Chase restarting mortgage foreclosures. So as everyone knows, over COVID, there have been 5 extensions on the foreclosure moratorium, which has been great because it's kept so many American homeowners in their homes. And the big question that, Stuart and I have been asked a lot is, when is that going to lift? When are they going to start foreclosing on people again? And how many Americans potentially could be foreclosed on? So This news today was interesting, and also seeing that Wells Fargo, which is another one of the top, third largest, is waiting until 2022. So Stuart, have you heard any more about that?
I haven't.
Yeah,
And I don't think it's a huge topic. I mean, it is. It's important to know like that these moratoriums are getting lifted. But something that's interesting is, a lot of the people that went into forbearance that chose that option to not have to make their mortgage payments during COVID, which is a great feature that these servicers offer. When you look back now at the data, most of the people that did that are already out of it and already back on repayment plans. So there's not a lot of people as a general population that are still not making those payments. So it tells us that statistically, hopefully, everybody's back to being able to afford those payments. And I think, I'm making up numbers, but I think at least half of the people that took forbearance just took it because they could. It wasn't because they needed to.
I would agree with that 100%. So let's see, through COVID, as Stuart said, rates plummeted in March last year, and then kind of bounced around a little bit, stayed pretty consistently low. This shows visually over the last year what rates have done. And if you look at the blue line, that's the 30-year fix, which most buyers are concerned with when they're looking for a long-term loan. And as Stuart said, they did shoot up a little bit in the beginning of this year when some great news for the economy was announced with, I forget the name of the act right now, the American Rescue Plan, that caused rates to go up a little bit because it stimulated consumer spending like he talked about earlier. So this, though, we put this quote in here because this is Freddie Mac, who's one of the foremost authorities on mortgages in our country. And they said that basically because of the availability of the vaccine, the passage of the American Rescue Plan, and the labor market recovering, which had the largest, we had a huge gain with 916,000 jobs in March, that these are all amazing signs for our economy recovering. And because of that, they expect conditions to remain generally favorable for the housing market and mortgage market through 2022. So this is a great, big, bold statement that they're making. Stuart, do you agree with that or think that that's what we're going to see?
I do. And like you said before, none of us have a crystal ball, but I think we're going to continue to see economic spending, at high levels. Maybe it decelerates a little bit, but we can't confuse the word deceleration with things dropping like a rock, right? It means that at the rate at which it's going up, it just doesn't go up quite as fast. It doesn't mean people are just going to stop spending. So I think I do think the housing market's going to be strong for years to come. And with the supply and demand issues that exist in almost every market in the country, it seems like when you talk to other people or read other news reports, I just don't even see how it gets fixed anytime soon. So, but I could be completely wrong.
I agree with you, especially in our market with all of the housing indicators of job growth and corporate relocation and population growth. It's looking that we have, some wonderful years ahead of our housing market. This was an interesting one that Freddie Mac put out. They put out predictions, forecasts on what they think the average primary mortgage rate is going to do over the next year or two, what total home sales in millions across the country are going to look like, what percentage of housing price growth we're going to see. As we all know, last year, one of the best indicators for homeowners was how much equity everyone gained during COVID. It was amazing. And especially because of the rates and people refinancing, it's been more affordable than ever for people to stay in their homes, which is great. And then what total originations are going to be for the mortgage industry. So they're predicting that, 2021, we're going to be a little bit down from where we were in 2020, which is probably to be expected because of the refinance boom that Stuart talked about earlier. But that in 2022, we're going to be down a little more. So it'll be interesting to see what's going to happen. However, if you look at this, none of those are horrible numbers. They're still, if you look at the average home sales, it'll still be better than it was last year. So this is all very positive as far as forecasting from Freddie Mac. Would you agree?
Great.
Yeah,
definitely.
All right. So now, Stuart, if you could enlighten us on some product and program changes that have happened. I know, as you mentioned at the beginning of COVID, lenders really closed up, tightened up got rid of a ton of products, and over the past 6 months or so, we've seen that loosening. So where are we at now?
Yeah, I would say that you look at this slide and the bottom three, the non-QM, which just so you guys know, that's a qualified mortgage, which is essentially like a portfolio loan. So think of it as the bank statement programs. These are the programs that don't fit within that box, we call it, which, the textbook term is a qualified mortgage box. That's why those are called non-QM, non-qualified mortgage. But when we have somebody, let's say it's a business owner, and they don't show the income on their tax returns because of the way they write things off, which is very common, we can provide these alternative products called non-QM products, like bank statement loans. And a lot of those went away during COVID. Every single one of them is back now. So that's a win. DPA programs are all back. There's no exciting changes going on there. That's just business as usual. Same with FHA and VA, same with conventional. Everything that's normal is back. Some of the more niche products like the 10% down jumbo, the lower jumbo products that came into the market over the last 3 or 4 years, most of those got suspended in the last year. And that was a huge blow to the industry and to the consumer because, as you guys probably might know, there's a lot of people that want to go out and buy a home that's $1 million or whatever the case is, and they either don't have 20% to put down or they just don't want to put all that cash down and exhaust all their reserves. And so there was some great products for that, and we lost them for a year. And now it literally seems like overnight we've got 3 different ones back. They're all very good. They each have their own different requirements, but the bottom line is, that's the one that I'm most excited about because we had clients that I knew that as soon as this turned back on, they were going to be back in the housing market buying. So this will help give more options to buyers. The other quick plus on the 10% down, in my opinion, is when you're dealing with a market where people are having to navigate the psychology of purchasing a home at the highest price they think it's ever been, right? And that's not an easy pill for a lot of people to swallow. It softens the blow a little bit to be able to put less money down, right? Because if the $1.5 million house that you always wanted a year ago is now somehow trading at $2 million, well, it's a lot easier to put 10% down on that than 20% down because that was knocking people out of the market too. So that product does a lot of things, in my opinion, and it's great that that's back. And there's, for the record, to kind of close out this slide, there aren't many products left to come back. That's the other good thing. So there's only a few little lingering niche products that I won't even mention here that we barely ever used them, that we're waiting to come back. But all the ones that we primarily used are back and in full force.
Absolutely.
Can I jump in and ask a couple of quick questions on this slide here?
Sure.
Okay, first, I've been out of real estate for a few years. What is between conforming and jumbo? Where does jumbo start? What's the loan amount?
$548,250 is the conforming loan limit. So anything above that's jumbo.
Awesome. Second question, in regard to the down payment assistance in the FHA, I actually picked up one of your flyers from the office yesterday regarding the down payment assistance. What you were talking about as far as the price appreciation, I'm thinking back, the same thing as it was 20 years ago, 15, 20 years ago, that run up. Are you originating in being successful with a lot of those loans? Or, all you hear is stuff about getting rid of appraisal contingencies. You can't do that on an FHA loan. You can't do that for like a first-time home buyer. Is there still success in like that first-time market there these days in your recent experience?
Stuart, can I answer that one?
Yeah, go for it.
Yeah. So I think, Andrew, the challenge really with DPA buyers is getting the offers accepted. We can still absolutely close the loans and fund the loans, no problem. But really what the challenge is in this extremely competitive market, a FHA buyer that's, a DPA not putting money down may be looked at as a risk or a more risky offer to accept from the seller's perspective. So really it's more of a challenge, I'd say, getting the offer accepted than it is getting the deal funded, if that makes sense.
No, it does make sense. I'm just thinking of the economics of this. To have all these people with 20%, 50% all cash offers, they have to start getting equity somewhere. And so first time buyers have got to be able to get into the market. I'm just hoping that a great amount of them do. And yeah, I understand the part about getting them accepted. I would just wondering if once they were accepted, if they were getting blown out due to low appraisals left and right or something.
Well, and I think Andrew, if I can chime in for a second, this is super common. I hear these words get interchanged, and I think there's a little bit of confusion. There's a difference between an appraisal waiver and an appraisal contingency waiver. An appraisal contingency waiver is contract based, right? It's right. I'm writing this offer. My client, no matter what the appraisal comes in at, they're going to move forward or lose their earnest money. There's no contingency on the appraisal. That's number one. The waiver is something that the conventional loan products you can get, assuming that Fannie Mae and Freddie Mac give us that waiver. So on every conventional loan, we run those pre-quals, if you will, through their system, their automated underwriting system, which is referred to as the AUS. And that will tell us whether or not they get a waiver on the purchase. And we do see those waivers. And in that scenario, it's great because we don't require an appraisal to be ordered. So to your point on the FHA, on the government loans, you're not going to get an appraisal waiver. So you will have to get an appraisal. And then if you did have a contingency waiver on the contract, that person will be stuck, so to speak. If it comes in loan, they don't have the money to do anything about it. Does that make sense?
Yes, it does. Thank you.
Yeah. And I think, Andrew, now more than ever, what we're seeing is the agents who are extremely diligent and really great at negotiating, communicate well, they're winning for their clients in those situations. And they're winning, I don't want to say that they're necessarily influencing an appraisal, but they're encouraging the appraisal, right? Because they're providing that appraiser with the comps that they really want them to look at prior to the appraisal. So there's things like that I think great agents are really shining in this market. But, getting offers accepted in lower price points is obviously very competitive, as everyone knows. So Stuart, quickly, do you want to talk about changes to self-employed borrowers? I know you said with those non-QM products, the majority of them are back, but we are seeing that now they're wanting more documentation. So can you talk to us a little bit about what we're needing from self-employed borrowers?
Yeah, absolutely. Fortunately or unfortunately, our team seems to attract a lot of self-employed clients, and I'm kidding about the unfortunately part, but you'll get my joke in a minute. And jumbo. We do a lot of both of those combined together, and we've learned a lot because that bucket of consumer is the most difficult, the most challenging, requires the most loan surgery, as we call it on our team. And it really requires experts to put these deals together, be creative, and not only put the deals together to be successful, guys, but to be able to walk the client through it kind of with the heart of a teacher and be thorough and be clear and make sure they understand all the things that you're requesting, because that's the big challenge, right? A lot of people behind the scenes can put the puzzle together, but once they have to explain to somebody how they put the puzzle together, it breaks down very quickly. The communication just isn't successful. And so that's something that we take a lot of pride in, because we put a lot of work and effort into making sure we do that in a manner that keeps the client comfortable, because that's sort of the key. That being said, self-employment during COVID, when I was talking earlier about restrictions, this is really one of the biggest ones that we dealt with. And if you're self-employed, and even if you're a realtor, perfect example, okay, and you guys come to us to do your refinance, or any lender for that matter. So remember, these are all universal rules. These aren't specific to VIP Mortgage or our team. You're going to be required to show your last 2 years filed tax returns, most likely. Okay, so in this scenario, we'll call it 2019 and 2020. Then you're going to need to be required to show your year-to-date profit and loss statement for 2021 that has to be dated within 2 months of your closing. Okay, so you'll have to put together a P&L that shows how much in commissions you've had and sort of approximate your expenses. On the top of that, this is the kind of the kicker with COVID. You're also going to have to show 3 months of business bank account statements to essentially support your P&L on the deposits or the income that you're using on the P&L. So let me give you guys a real life example so this makes sense. let's say your 2019 tax return, your net income was $100,000. 2020, your net income was $120,000. Okay. In a normal world, we would just average those two, and whatever that average is would be what we'd use to qualify you. In the COVID world, we now add to that calculation your year to date. So we'll call it through May 1st. Okay. P&L. And if that P&L shows that you've had 3 sales so far this year, and after your expenses, you're at, $20,000 in net income. Of course, I'm just making this up. Well, if I average that $20,000 in net income for the rest of the year, assuming that's what you're on track to do, you're going to be on track to do about half the amount that you showed on your 2020 tax return. Okay. That's called declining income. So then that's going to trigger having to explain to an underwriter why your income is declining. If it's severely declining, most lenders will just stop you dead in your tracks and say, I'm sorry, you can't get a loan right now. So that's one big unfortunate part. Now, same scenario, but now let's say you show a P&L that shows that you're on track to make $100,000 a year again. So you've already made, we'll call it 50,000, right? We're almost halfway through the year. I'm just going to times that by 2, easy cowboy math. We're at 100 grand. So that's great. Now we supported your 2020 and 2019 average. So yay, we can use your income. But now I need your last 3 months business bank statements. And if your business bank account does not show deposits that we can add up that will support the income you put on that P&L. So let's say you told me 50,000 in income, but I look at your last 3 months business bank statements and you've only got $10,000 in deposits. They don't support, you won't get the loan. And I don't mean to sound so kind of black and white about it, but hopefully that helps illustrate how an underwriter looks at it. So you can imagine that's a lot of paperwork for clients to put together, not for everybody, but now let me double down on that. Now, let's say you're a realtor. You also have an LLC with your best friend that you guys set up to buy rental properties. Then you've also got another business you invested in with a buddy 10 years ago. So you see where I'm going with this. If you have all these other self-employment income sources, guess what? I need all the same documentation, the tax returns, the P&L, and the business bank statements on every single one of those. So does that help does that make sense, Liz?
Yes, thank you. That's exactly what I think that agents need to know to help guide their self-employed clients. I think, as you said, thankfully, we have become really amazing at structuring self-employed borrower deals, especially in the jumbo space. So we can help advise you guys on anybody who has questions on this. But really, we just wanted you to see, although the programs are back, which is great, the documentation required is more than ever. And depending on what the documentation shows, they may or may not be eligible for the loan, from an underwriting perspective. So any questions on that, we're always here to help you advise your clients, but that, it's a little trickier now with those, isn't it?
Yes. And I can't tell you guys how common it is that we get a phone call from one of our agents that says, oh, don't worry, this guy will be fine. He's got plenty of money. I know he makes a ton of money. He's a, heart surgeon, whatever the case is. I've just unfortunately been doing this for too long. So as soon as I get all that paperwork, you'd be surprised how many of those people have an issue qualifying because the way they're doing their self-employment on their taxes, the way their deposits are coming in or not coming in because of COVID. And for lack of a more eloquent way to say it, guys, it's been a real mess. And I cannot wait for the self-employment rules to ease, because that will just make our job so much easier. And the poor client, won't have to do what we call the walk of fire.
Yes. So here we just wanted to pull this chart up for everyone because we have a lot of buyers that are apprehensive about rates, right? Rates are rising. I should have bought last year, whatever it is. But we really I think pulling it back from a historical perspective over the last 50 years, rates are still incredible. And if you really look at affordability in our marketplace, it's still very good. So we just wanted to show you, long-term historical scale, we're way down here in comparison to where we have been in previous years. Just for your information, the gray areas are recessions. So it shows what happens to rates during recessions. I don't know why they haven't put anything in here yet, because I guess they don't consider COVID a recession, but still rates are fabulous. The average 30-year fixed rate mortgage right now is trading at 2.9 5%. That's with a very small amount of fees or points paid towards that loan. Again, these are national averages based upon a top tier borrower. So every buyer is going to be quoted different rates based upon their unique financial situation. But these are, a great ballpark to show people if they're curious. And projections, let's talk a little bit about this, Stuart. So as we get this question all the time, what's going to happen to rates? Really, all we can look at is the housing authorities and what they're predicting. So I don't know if you want to talk about this one for us and let us know what they're seeing.
Yeah, and this kind of goes, I sort of mentioned this earlier, where so Fannie Mae and Freddie Mac came out with their, forecasts at the beginning of the year saying where they think rates would be at the end of the year. And they predicted that 3/8 increase I had mentioned, which is dead on. If you look at the Freddie Mac one, I mean, it's at, close to 3.375, just over 3.25, which is sort of what I was saying earlier. So now the average interest rate right now is about 3%, average, national average. So we're a little bit lower than where they think it's going to be at the end of the year. It is interesting that you got Wells Fargo over here predicting a much higher rate. If we were in Vegas right now and I had to put like dollar bills on each of these bar graphs, I wouldn't be putting any money on the Wells Fargo one unless I was betting on them to be wrong. So, I don't think that's going to happen. That would require things to really take off really, really fast. And that doesn't mean it's not possible. I just don't think there's enough runway left in 2021 for that to happen. So I think these are all pretty fair predictions. And I wouldn't be surprised if rates are up another 1/4 point in the next 12 months, and not necessarily by the end of the year. And I don't think rates are going to do anything drastic as far as upward pressure, which means going up, really in the next couple of years. And hopefully I don't eat those words sometime soon, but I just don't see it happening.
Awesome. Thank you for that. And worst case scenario, if they do go up a 1/4 point over the next 12 months, that is not hugely that doesn't hugely affect the average $400,000 buyer as far as payment goes. So it still makes housing very affordable. It should not take a ton of buyers out of the market, which is great news. If anything, it could soften the demand that we're seeing right now, maybe, and make it easier for buyers to get homes, but still have a very increasing and positive market. So that would be good. So you just touched on this, but why would rates, could they rise? Why could they fall? Here's some reasons. Let's talk about that.
Yeah, but I'll just hit these real quick. I know some of these I mentioned, but inflation's really been the big topic in the last few months. And inflation happens when economic risings occur, right? The spending that I talked about, meaning that and we're already seeing it, right? I mean, what is inflation? Inflation is the time value of money, right? Which means that my $2 today buys me one of these pens, but that $2 tomorrow only buys me half of this pen, right? Your purchasing power goes down and the value of that dollar goes down. And we see that in increased prices right now, as you guys probably know, if you've shopped for anything that's kind of on the bigger ticket item side, the prices have gone up. But the conundrum is a lot of that is supply and logistic issues and supply and demand and not being able to get those products manufactured fast enough. That's like a perfect example of what's happening with lumber. It's not that we just can't get to it because of all the things that are going on, but that's already starting to ease, I'm seeing. So point is, the Federal Reserve watches inflation very closely to figure out what they're going to do with the interest rate movement and how they're going to change the overnight lending rate or not. And the big fear has been inflation is going to just explode like a bubble. A bubble is maybe the wrong word, but right, it was going to shoot up like a rocket into space as soon as the vaccinations hit and everybody was spending money. And we started to see a little bit of that. And now you're starting to see in the news that inflation's not as bad as they thought. And if you watch CNBC every morning for a week, I promise you'll see at least 3 debates of 2 people battling over inflation's going to take off versus no, it's not going to. So that's the big thing that they're watching. The improving U.S. economy, we already touched on. And then Liz is dead on. A reason things where rates could go back down, I think, is another catastrophic event, whether it's a pandemic or something else. But if I were in the consumer shoes, and I am because I am one, I would not be making any decisions based on the fact that rates will probably go lower in the future. So I wouldn't be waiting to get a mortgage because I thought rates were going lower. It doesn't mean they won't, right? But the chances are much slimmer than they were before. And I think that we are in a rising interest rate market.
Thank you for that recap. So now let's talk about some ideas for getting offers accepted in this crazy competitive market. I know we help our agent partners by providing a great template to listing agents on bullet points to strengthen their client's position. We're happy to provide that to all of you in an email after this class today. But that, I think, is a really strong way is, copying your lender on the offer. Hopefully they're diligent and willing to do so. But I know when our agent partners copy us on their offers, we immediately chime in, strengthening that client's position. We're happy to call the listing agent to say that they've already been, gone through pre-underwriting. Underwriting is in-house in our company. And really we can get all deals closed in under 30 days. So I think having a strong team with the agent and the lender is a way to really help get deals accepted. Any other ideas, Stuart, ways to get offers accepted that we're seeing agents win with today?
I honestly think that you nailed it. It's the communication piece. As long as I've been in this business, I've never seen more listing agents calling us on the pre-call to ask, how's the buyer look? What's going on? And it makes sense because you guys have multiple offers and you're trying to vet them out. So I think that, I'm always big on communication and being proactive. If you get to people first, you have the best service. So if we know you're writing an offer and we know who the listing agent is, we'll just once we know you've submitted it, we'll just reach out to Liz, listing agent, and say, hey, Liz, this is the Crawford team at VIP Mortgage. Just reaching out to introduce myself. We fully vetted this buyer out. If you have any questions, let us know. Our team's available 24/7. So we're all about high communication. We're going to give you weekly LSUs. We kind of go through a whole script, if you will, on all the things we provide. And I think that the main purpose of that is just to show that we're professionals. You're not going to be worried about us not performing. You're not going to be worried about us not answering your phone calls or getting back to you with updates, right? Because you guys know this. The frustrating thing is when you're trying to call a lender or get an update and find out what's going on, and you just can't get anywhere quickly. And we preach urgency big time on our team because this is a I wanted it 5 minutes ago business. So we try to cater to that and accommodate it. So yeah, I think that's really it. Proactive communication, and it works. We see that being successful when we do that.
Absolutely. We see it all the time. I think, listing agents want to work with agents who are, great, highly communicative and professional and going to help get the deal done. They want to work with lenders. So we're going to do the same. Everyone has seen challenges over the past year, I think, with different transactions. So as easy as everyone can make it, I think, is their vote. Now, one thing that we're also getting all the time lately is agents calling us and saying, oh my gosh, I had a buyer that was, with another lender, and now we are getting loan denial. What can we do? So I know we've had a lot of situations, Stuart, lately where we've been able to take that file over and save the deal and close it quickly. Do you want to maybe give us some ideas or ways that we've been able to help save those transactions?
Yeah, I think, and literally just in the last 2 weeks, I've seen more than ever these kind of will you save the day phone calls or emails, and it's people under contract. Well, we had one the other day, they're literally closing in 6 days. And the realtor said, I know you can't close that fast, but how fast can you close? Because these guys are now telling me no 20 days. So we can easily get it done in 10, 11 days if we need to, and we get a rush appraisal, et cetera. So the way our systems and efficiencies are built, we can move very fast through the assembly line. The other thing too is we built our business based off relationships, right? Because if you leverage relationships, you can get things done. And what I mean by that is, if I've got a great relationship with the owner of the appraisal management company and an appraiser is not responding, or we need to get that appraisal in, you better believe I'm making a phone call to the president of the AMC and using that relationship I have to say, what's going on? I need you personally on this to figure this out. And of course, we do that in a courteous way because we're trying to help each other out. We all have the same goal. But I've had to do that more than I'm used to in the last 3 or 4 months. So that's one way we can help. The other one too is really just kind of the age-old problem this industry has always had, meaning the mortgage industry, which is you just have lenders that don't fully diagnose the patient at the first visit, right? They think the patient's healthy. They asked them a few questions. They think they're good, but they forgot to run the blood test. And then they get 3 weeks in and realize, oh, shoot, underwriter asked for a blood test. We got to get that blood test. And that comes back and there's a problem. That's what most of these issues are, is people calling us saying, oh my gosh, now they're saying he's not approved because they missed this thing on his self-employment loss, et cetera, et cetera. And then we dig in and we joke on our team, we try to make chicken salad out of it. And we're very good at that. My advice would be this. If you get a pre-qualification from a buyer that comes to you, meaning your buyer, from a lender that you have no relationship with, no matter how much your client tells you that's a great lender, I would highly suggest you get a second opinion at the very least from a lender that you know and trust. It's really that simple. And explain to your buyer why that is, and you can cite these kinds of problems. And the agents we work closely with, we've helped coach them on that have started to do that, are already seeing like this light at the end of the tunnel, like, oh my gosh, like I'm so glad they talked to you guys, because they even felt better about talking to you guys than the guy that they loved. And now I know the transaction is going to go smoothly, at least on the mortgage side. So there's just a lot of benefits to making sure you set it up with your family network, if that makes sense.
Absolutely. And I think, Stuart, one thing, that great lenders do, as our team does, is we take so much time up front in that initial discovery call to diagnose any issues that could potentially come up later and find a way to solve them before they hit underwriting, to not delay transactions. And I think that is something that, unfortunately, as lenders were experiencing such a tremendous amount of volume over the past year, they weren't able to slow down and take the time to do that at the beginning, because they were just trying to get through what they had to get through. But that's something that we find, if we give you a pre-qual, if we give your client a pre-qual, it's bulletproof. And unless there is something that we were not told about, or something that was not, disclosed properly, that client will be able to close on time. So that is definitely, I think, a benefit of having a great lender partner and working with agents who have great communication as well. So now we'll wrap it up with questions. So if anyone has questions, feel free to type them into chat or unmute yourself. We'd love to hear from you. If you think of something after the fact, our contact information is here. We're always available to answer questions or be a second resource, as Stuart mentioned. And we look forward to working with you and your clients. We'd love the opportunity to do so. We're always here.
Can I jump in and ask two more questions? One of which I unfortunately got a very important phone call, so I wasn't able to hear the tips and tricks. You're recording this. Is this going to be posted on the MAP page?
I will email it out to everyone after the class, and then we will have it posted on our Crawford Team YouTube page as well.
Outstanding. Also, does anybody on your team, any loan reps or anybody can assist Spanish-speaking clients?
Yes.
Awesome. Awesome. Thank you so much.
Yes. Any other questions? Well, we really appreciate you joining us. We will sign off, but as always, feel free to reach out via email or phone with any questions or concerns. We would love the opportunity to assist. Thank you for your time today.
Thanks for joining, everybody. Thank you, Liz.
Absolutely. Have a great day.
You too.